Good morning, everybody. Welcome to our annual power market outlook for 2024. This is a repeat of a seminar that we ran last year, and we'll continue to do this particular one as part of our webinar series on an annual basis. You're all very welcome. Good morning to those joining from the UK. Good afternoon for those that are joining from further east. My name is Phil Grant. I'm the Global Power Lead for Baringa. I'm joined this morning by 4 colleagues: Arif Patel, based in our Dusseldorf office, Caspian Conran, Chris Kavanagh, and Nikita Swankar. This morning, we are looking back at the last 12 months and asking ourselves, what have we learned in terms of geopolitics, macroeconomics, technology trends, investor behavior, and indeed consumer behavior? What has the last 12 months taught us, and how does that shape our future projections and future scenarios? As the basis for this discussion, we'll be using our Q4 2023 analysis. We're in the process at the moment of updating for our latest edition of reports, the Q1 2024 editions, and they'll be issued to our subscriber base over the next few weeks. Our scenarios at any point in time are our best view of the future. They are an independent view. They are used equally in buy and sell side processes. We're not swayed whether we're on the buy side or sell side of a transaction. It's our independent view, our best view in the reference scenario of how markets may evolve, combining those themes of geopolitics, macroeconomics, technology trends, policy, regulation, investor behavior, and consumer behavior. And clearly 2023, perhaps a little less exciting than 2022, thankfully, but there are some key lessons to take forward as we evolve the scenarios. We will spend about 40 minutes presenting today. We very much welcome Q&A, and please, I'd invite you to use the chat function. We may answer some of those online, and towards the end of the seminar, we'll have a Q&A forum where we'll take questions. But with no further ado, I'll pass over to Caspian, who's going to set the context for today's discussion, and I'll start the proceedings. He'll then pass over to Nikki to take us forward on some of the background and context.
Thanks, Phil. Wise words in sense of an interesting framing when we say it's less exciting than 2022. I think that's fair to say at the end of 2023. But some of clearly the sort of thematics that we saw in the macro environment emerge during COVID, but also obviously in the result of Ukraine, have continued. Most notably, whilst inflation has peaked, it's still a challenge, and there's a challenge to return it to target, hopefully by half year of this year. But that's clearly still generating a higher rate environment, maybe not higher for longer, but certainly still normalizing rates in a way that we haven't seen for the last 15 odd years. Downstream of that is clearly an emerging cost of living crisis, which is putting challenge both on household finances, but also budget deficits in Western democracies. And I think to add to that, there's the continuation of what we're seeing, which is global fragmentation, the sort of end of the post-war American hegemony of the Great Moderation, and the start, whether it be we point to the Red Sea or we point to Ukraine, of increasing frictions in the geopolitical environment. And that's creating pressures on supply chains of where to locate, where to nearshore, and potentially competition for critical resources and critical minerals, which are actually critical components for our energy transition, as well as military technology. The policy response to that so far has been one of national resilience, the notion that maybe globalization as we know it has peaked. We're seeing regression in certain trade in certain sectors, particularly those in sensitive sectors such as tech and those critical resources needed for the modern economy of tomorrow. And that's going to have profound implications for us looking to deploy clean tech and renewable assets in the years ahead. And I think the last point is that the extension of national resilience, and at least in the energy sphere, is pro-cyclical for the energy transition. National resilience in Europe, probably given our lack of domestic resources, unlike the US with shale gas, means more renewables, means a clean and accelerated energy transition. But as more parties join Europe on that road, there's going to be greater competition for the critical components and the supply chain in needing to support that. Most notably, of course, the Inflation Reduction Act, which has turbocharged manufacturing capacity for certain components in the United States, but also, of course, added demand to a shortage of components. So I think, as Phil says, a continuation in some respects of the themes that we saw in 2022. And the core message of the macro context is that there are adverse challenges that we're now facing. And actually, our view is that those challenges are likely to be with us for the not foreseeable future. I'll pass over to my colleague. Thanks.
Thank you. So if we go to our next slide, here we compare our end of 2022 outlook and our end of 2023 outlook to kind of gauge how Europe began to find its new normal, but also to give reasons to why our outlook has shifted over the last year. So in our top row, we can see that European gas prices were exceptionally high towards the end of 2022 with the Russian invasion of Ukraine. They remained high, however, did come down slightly towards the end of 2023. And due to the close relationship between gas prices and electricity prices, we see a very similar dynamic playing out for the short-term electricity price outlook, but also for price volatility. Where we saw the most difference was in emissions, in that towards the end of 2022, they were in fact rising because a lot of countries in Europe were suddenly having to rely on the use of coal and gas, which are highly emissive fossil fuels. However, by the end of 2023, we saw the return to trend in that emissions were again falling as there was an increased use of renewables in the electricity market. State intervention also saw significant shifts towards the end of 2022. In order to protect consumers for those abnormally high electricity prices, there had to be significant measures taken into place, such as price caps and policy packages. However, these became far more moderate towards the end of 2023, as they were either coming to their expiration or there was a reduced need to protect consumers as those prices were coming down. I'll now pass on to Arif, who will take us through what this means for our outlook and those emerging trends.
Thanks, Nikki. So energy transition journey for Europe is gradually progressing, just like Caspian and Nikki mentioned. So with renewables taking a prominent role sooner than anticipated. However, there is a notable development. The transition is incurring higher costs. Various factors are contributing to an increase in expenses associated with the transformative shift. As we analyze these changes, the outlook is evolving. It's not just a shift in the energy landscape, it encompasses changes in climate trajectories, power market dynamics, and governmental strategies. So in the upcoming section, we'll walk you through why the pace is accelerating and the factors influencing the changing cost dynamics. So let's begin, and my colleague Chris will comment with a section on how Europe is further expediting to transition.
Thank you very much, Arif. So yes, as we say, we see Europe accelerating the transition, and here we're just looking at why. The macro context of this is that renewables remain attractive in this environment across all three of the dimensions of the energy trilemma: energy security, sustainability, and affordability. So in terms of energy security, where previously, sort of towards the start of the transition, then we were seeing renewables sort of characterized as this intermittent and reliable form of energy. Obviously, they are intermittent, but Europe has realized how unreliable the imported fossil fuel supply can be, obviously with Russia, Ukraine, but also other factors with such as the Red Sea, as Caspian is mentioning, and Suez Canal and so on. And so Europe now sees renewables as a source of energy security. We've got homegrown generation. Now there is a threat to that in terms of the supply chain for renewables and the threats to sort of global trade, and also the problem about where do these things get made. And Europe's starting to address that and to try to deal with problems at solar manufacturers, for example. In terms of sustainability, governments keep increasing their targets. We keep getting more renewable purchases by companies, as Arif will show you shortly, and it has continued to increase in salience as an issue as we see the weather effects and so on starting. So again, that pushing renewables forward. Where this is starting to fade a little bit, and we sort of faded the arrow to indicate this, is in terms of cost. So renewables are still cheaper than fossil fuels per megawatt hour, but we've seen some increasing challenges in terms of cost of renewables, and we'll go on to explore those a little bit later. Those perhaps what's the biggest threat probably to further acceleration. So if we move on to the next slide, please. And so we just focus on the right-hand side here. Really, this is sort of our overall outlook, that where from 2021 to 22 we saw a really significant increase in the pace of the transition. This time, not a great deal of difference in the cost. This time we do see a further acceleration. It's less profound than last time. It's not yet slowing down, and obviously, we're still projecting great growth and more growth than we were, but it's not as profound a shift as last time. Where we do see a very profound shift is in terms of higher costs. The cost of the transition have greatly increased, and we'll talk about that in the second section. This section just focusing on the speed. We do see an increase in the speed of transition. That's driven by corporate demand in PPAs, driven by the ambitions of governments, and also driven by governments starting to actually make some of the policy changes required to reduce the barriers to development, which Arif will go on to talk about in a second. So Arif, I'll pass over to you to talk about this pace of transition.
Thanks, Chris. So on this slide, it's basically showing our 2030 projections of power generation mix. We see energy transition in Europe has been accelerated, mainly in the last couple of years, while it's continuous in our latest outlook. So the share of renewables has seen a notable increase from our pre-Ukraine crisis projections in 2021, now around 70% from 65% in the year 2030. However, we may say it's slowing down due to some hurdles that still exist and need addressing across the rest of the 2020s. In this transformative journey, solar power emerges as a standout technology, showcasing substantial progress. And the driving forces behind this acceleration include persistent demand for power purchase agreements, predominantly from corporates, ambitious policy upgrades across European countries, and a collective push for energy independence post the Ukraine crisis. In the next slide, I will delve into the specifics, exploring these factors and their respective actualizers. Now, basically, that leads to our first actualizer. The first point that stands out is in the face of volatile macroeconomic conditions, the European power purchase agreement market remains remarkably resilient. Despite some challenges, it has demonstrated robustness, maintaining fairly consistent demand for renewable energy deployment, averaging 7 gigawatt from 2020 to 2023, as you can see from the left-hand side on the chart. Now, solar and wind are at the heart of this growth. While on the right-hand side, you can see the second key takeaway from this slide is that pivotal role played by tech industry. Their growing demand for green electricity procurement and commitment to enhancing sustainability targets, especially for data centers, serves as a robust driving force in the market. Now, this compensates for softer demand observed in other sectors. Presently, the cumulative contracted capacity in the tech sector is noteworthy, standing at an impressive 11 gigawatts. Meanwhile, the response from heavy industry, primarily shaped by high power prices and market volatility, closely follows the tech sector with a capacity of 9 gigawatts. All in all, looking ahead, we anticipate the continuation of this trend with the likelihood of more medium to long-term PPAs being inked between renewable developers and corporate buyers. Additionally, there is a potential emergence of innovative commercial structures across the rest of the 2020s, signaling an evolving landscape in renewable energy transactions. Now, if you go on the next slide, here, basically, as you can see, let's closely examine the 2030 projections for European solar and wind capacity, aligning them with the REPowerEU targets. On the left-hand side, we can see solar, and right-hand side, wind. So as we scrutinize these projections, it becomes apparent that the post-Ukraine crisis aspirations carefully outlined by EU states have yet to fully materialize in our 2030 outlook against REPowerEU targets. Notably, there is a significant deployment gap, often referred to as the aspiration gap or ambition gap, in both solar and wind. While these gaps remain substantial, there is a positive aspect. They seem to be narrowing compared to our early assessments. The aspiration gap, currently around 250 gigawatts for combined solar and wind capacity, highlights the challenges that countries encounter. It indicates that despite heightened government policy, meeting REPowerEU targets remains a formidable challenge. In the upcoming slide, I will delve into the whys behind these aspiration gaps.
Arif, can I just pause you there for a moment? A technical explanation. This is a slightly different version of Teams. There's a Q&A function on the top of the chart. So I'd invite people to use that Q&A function for questions. We've already had a couple filter through around supply chain risk and the distinction between corporate PPAs driven by cost and those driven by sustainability. But I just want to highlight people that it's a slightly different variant of Teams that we're using this morning with that Q&A function at the top. So please pop questions in there, and we'll do a wrap up in a moment or so. Back to you, Arif.
Thanks, Phil. Now that basically leads us to our actualizer 2. Now, let me explain the chart. So this chart is showing the decarbonization targets from European countries against suggested REPowerEU targets in the proportion of final energy consumption generated from renewables. Amber dot is showing countries' target set in 2019, whilst green dot is showing countries' updated target in 2023, while the red shows if country has not updated its targets or it's got worsened compared to previous one. The primary driver of the aspiration gap that we can see from these charts is that some member states lack sufficiently ambitious renewable targets aligned with REPowerEU. So despite an evolving landscape with increased policy ambitions in specific EU states over the past 2 years, driven by the pursuit of energy independence, high power prices, volatility, as we mentioned, there is a notably diversity in renewable target ambitions. So certain member states are exceeding expectations, as you can see from the bottom of the charts, while many others are still fully aligning or in the process of aligning with REPowerEU, emphasizing the complexity of the transition. So overall, this diversity in ambitions emphasizes the complexity of the transition, where varying level of commitment and progress shape the overall trajectory. In the next slide, we'll walk you through the major hurdles that is basically faced by European power markets. So European energy transition path towards further ambition still encounters significant hurdles, particularly in intricate deployments of renewables. These challenges persist due to barriers in development process, including issues with planning, permitting, and grid constraints. This situation distinguishes Europe from our counterparts like US, creating prolonged and most costly journey for deployment. So as illustrated on the left-hand side of the slide, the average lead time for renewables project in Europe was around 7.5 years, in contrast to the US, where it's shifted for 5 years. Now, average lead time, we mean development time until the project is ready to build. Now, examining the percentage share of grid connection and transmission costs in the CapEx on the right-hand side, we observe a relatively high average cost in Europe, but with considerable variation across different member states. So these collective challenges impose limitations on the ability of European states to achieve their aspirations for deploying the desired amount of renewable capacity. Addressing these complexities became paramount for steering towards a more efficient and streamlined path to energy transition for meeting 2030 target. That basically leads to our last but not least third actualizer on the next slide. In 2023, as we can tell from the slide, we observed a policy innovation in member states aimed at reducing barriers to renewable deployment and aligning with Commission directives to expedite development. So, for instance, permitting times for solar and onshore wind renewables are being shortened, with repowering projects potentially obtaining permits within 6 months to 1.5 years. These initiatives are being translated into action at the national level. As you can see from some of the examples on the right-hand side, Spain, basically for renewable projects as large as 150 megawatt for solar and wind, the development time has been shortened. Similar development on Bulgaria and Poland as well. So collectively, we anticipate these measures will foster further growth in development rates, marking positive stride toward achieving our renewable energy objectives across Europe. In the next section, Chris will walk us through the consequences of the acceleration of renewables and costly transition we've seen so far. What's your, Chris?
Thank you very much. Thank you. So we had a bit of good news in that last slide about governments addressing some of the barriers to renewables development. This is another good news slide. This is showing the emissions trajectory we now project to 2030. The great news is that the emissions over the decade, in contrast to last time, are actually looking like they're going to be lower than was predicted pre-Ukraine. So just to explain the chart a little bit, the light blue here is the change in emissions we saw in our previous outlook at the end of 22, showing far more emissions at the early part of the decade, and that was driven by those high gas prices that drove the return to coal, and so even some coal plants being brought out of retirement to supplement where there were problems with gas availability. In this new outlook shown in the dark blue, we showed again the change versus 2021, but in our latest outlook, and we see at the start of the decade there is still more coal burnt and hence more emissions than we would have said pre-Ukraine. So the gas prices are still fairly high, but we see that trend reversing much more strongly in the later part of the decade, driven by that greater rollout of renewables that I've been talking about, the greater generation for renewables displacing fossil fuels, and coal retiring more quickly than previously anticipated. So it's sort of two dynamics: less fossil fuels overall driven by renewables, and also just less coal shifting to gas, and gas being basically the fossil fuel that keeps going. So we move to the next slide. The second consequence we've identified here is about the volatility of prices. So we see essentially prices becoming a little bit more volatile, with them shifting out of the middle band and shifting into very low price hours, very high price hours. So these are price projections in the day-ahead market in a particular European country, which we've not identified for confidentiality reasons, but it's a pattern we see across a couple of markets. So to explain the chart here, the grey dots show our end of 2021 outlook pre-Ukraine. And in that outlook, you've got 90% or so of the hours were in the middle bracket, from 5 to 100 euros per megawatt hour. So the vast majority of prices there in that kind of normal price hour. And the pink dots show the end of 22 outlook, and then the blue ones the end of 23 outlook. And we see that essentially there was a trend that started in 22 and has continued. So hours have moved from that middle bracket out into the extreme lows and extreme highs. So now we have only about 57% of the hours left in that middle bracket from 90% previously. Far more low price hours. That's driven basically by more renewables on the system, so more hours of renewable surplus and even curtailment. And then on the right hand, then we see far more of the very high price hours, and that's driven again by less coal, less base load, and more of the kind of flexible plants coming in and facing high carbon prices as well as gas prices. So we move to the next slide. Really links to this one. This means change in the role of gas, and so we see, somewhat surprisingly, a larger fleet, but that fleet running less often, low utilization, and and becoming much more this source of flexibility around renewable availability, as opposed to a source of base load. So on the left-hand side, we see that in 2030 across Europe, we see actually a 5% greater gas capacity than our previous end of 22 outlook, but lower generation. And so this equates to fairly significantly lower utilization across the gas fleet, even though it's a larger fleet. For renewables, a much more simple picture, more renewables producing more electricity. Then on the right-hand side here, we've had a look at what that means for sort of the daily profile of gas generation in Europe. And this is showing the percentage of average hourly gas generation in that particular hour. So if this were in absolutes, because of that lower generation, this blue line representing the latest outlook would just be lower, but you wouldn't be able to see the pattern as much. And the pattern we wanted to bring out is how essentially we've got higher peaks and lower troughs. And especially when you compare this to pre-Ukraine, it's quite a profound change in terms of that flexibility of gas moving very much, as we say, away from baseload and into flexibility. And so I'll pass over to Caspian and Nikki then to continue the story with the more expensive transition. Caspian, over to you.
Chris, I was wondering actually whether it would be worth just at the end of your section to pause. I know there's some hands up, so I may just allow, for example, Nikki Hunter, if there's a question, I'll allow you to come off mute if that's what you wanted.
The Q&A is not working. So I get an error message. It says the Q&A is not working. Please contact the meeting organizer.
Okay, apologies about that. If people want to take a moment to ask a question, if you raise your hand, I'll allow you to come off mute. We can spend 5 minutes now just discussing the first part of the section before going on to the second part.
Let's press on for now, Caspian. I have got a couple of questions here around supply chain risk, which I'd like you to touch on, and
sure.
Dependency on manufacturing in China. To what extent are we dependent on the supply chain functioning effectively over the next decade, and to what extent is that a major risk factor? And then Chris around corporate PPAs, but we'll take those in a moment.
Okay, so as Chris and Arif just walked us through, the first part of this presentation was to say that actually we see the European transition continue to accelerate. We don't see that changing, and that's driven by three kind of actualizers or drivers: the resilient PPA market, upgrades in policy ambition, and policy reform around barriers to development. And I guess that's the positive side of the story. And as Chris showed on the graph there, that moves the ball from 2021 to 2022 and to 2023 on the x-axis. But of course, the y-axis on that graph is not quite as positive, which is around costs. And so we frame this presentation as a faster bit dearer. That is to say that, yes, we're in the midst of an accelerated transition, but that transition is becoming more expensive, and that will clearly have implications for those on this call. There's three core drivers to that, which we'll take in turn. We'll share our latest WACC and LCOE numbers with this audience. The first is obviously financing costs. Both debt and equity have risen considerably. Commodity prices have also risen, and that's impacted downstream capex as well as freight and labour input costs. And the third is around protectionism, and as Phil pointed out, an increasing challenge around what the supply chain can provide in terms of the material inputs. So if we go to the first slide, then we'll look at our financing outlook on the next slide. And I think the first thing to say, which is the obvious, is clearly we have just experienced the fastest and deepest rate tightening cycle in modern history, at least the last 50 years, raising rates from at 0.25 basis points to over 5%. That's happened in a relatively uniform way across all developed markets. I think there's one thing to say that is interesting, that is that narrative of higher for longer which we heard in the half year of last year was started to give way a bit. Actually, rates and the outlook for rates has started to come down, and we expect rates to probably settle anywhere between 3 and 4% by the end of this year. So coming off from those highs of about 5.56%. Having said that, our medium-term outlook in terms of financing cost is clearly quite significant. In 2024, our outlook now is that financing costs for debt and equity will be 22% higher than they were just 24 months ago. And actually that challenge, that outlook is likely to stay persistent with us until 2030, where we still see financing costs 11% higher than they would have been in 2022 under our old outlook. So there's some positive story in terms of rates starting to come down a bit, but actually in terms of the next few years, we still see a significant change in the financing outlook for those looking for leverage and looking to raise capital for the energy transition. So that's our one cost driver, fundamentally raising costs of deployment. Our second driver is to look at CapEx on the next slide, where we see actually a similar level of challenge in the market environment across a range of the critical inputs. When we look at a share of materials for a wind turbine, steel, iron and copper making up nearly 100%, you see significant price rises relative to 2019, well above the rates of inflation. So of course, subsidy protection, which could be given to you to protect you from headline rate of inflation, is not going to be sufficient in this instance, given those price rises, 81% on steel, 75% on iron. More nebulous, of course, is freight costs, which impact CapEx in a different way, up 132%. That's come down a little bit more recently, but actually some of the challenges around the Red Sea is we're starting to see that rise again. And of course, the challenge of labour costs, specialist skills, and the lack of fungibility of some of those skills when we're looking at old fossil sectors and moving those skilled labour into the renewable economy. What does that mean for our CapEx outlook? Well, particularly for offshore wind, relative to 2022, in 2024, we have CapEx outlook up about 34%. And again, that's likely to be persistent, still high, elevated at around 18% in 2030. Slightly less for onshore wind, but nevertheless still significant. So across those two drivers, we're seeing significant cost impact. And obviously, that will have an implication in the cost and potential subsidy regime in the demands, as well as on wholesale prices and LCOEs. So if we go on to the final slide, slightly more nebulous, but I think still important, is this factor in the macro environment, which is increasing competition for the supply chain, leading to protectionist impulses across the major players. This is, of course, a big prize to secure the supply chain, to secure the high-paid jobs, and of course to reduce any foreign leverage in your supply chain by domesticating as far as possible critical components and manufacture. And we're seeing across, whether it be China and their bans on rare earth metals, the US IRA, and obviously the subsidy, domestic orientated subsidy regime there, or the European Union's Critical Material Act, we're seeing a concerted effort, whether that be domestic sourcing requirements, the exclusivity of certain subsidies to certain domestic companies, a clear and concerted effort to secure the supply chain. And the impact of that is likely to be a higher cost net. We are moving away from a world, a global order, where manufacture is orientated at the lowest cost with the most efficiency, to one where certain manufactured goods will be domesticated, even if it is not cost efficient or cost optimal to do so. On the right hand side, you're seeing the impact of that, trade measures installed by years across goods, services and investment, a clear rise from about 2017, 2018 levels, up 193% in 2023. So something a little bit harder to quantify, but nevertheless significant for those looking to deploy and ultimately exposed to the cost and capex of manufactured goods in the clean energy supply chain. Final slide from me then. So what does this all mean on the next slide? Well, I think it's really pertinent because fundamentally we're departing from an environment that was relatively benign. If we think of the environment from 2010 to 2019, financing costs continued to fall because base rates and corporate debt continued to fall, down 37% relative to 2010. But also CapEx material costs continued to fall as there was deficient demand, excess supply, especially coming out of China, and the huge economies of scale that the Chinese were able to bring to bear in the technology market brought costs down by about 20%. So combined, we actually lived through an environment of declining LCOEs down by about 32%. The challenge now is clearly we may be in an environment for the first time where that environment is in reverse. Financing costs up 21%, CapEx up 20%, and LCOEs up 23% in 2022 to 2024. So a challenge to the environment in terms of how do we deploy at speed and at scale. I'll pass over to my colleague Nikki now to explore the implications of that.
Before we do, just if people are still having problems with this chat function, Q&A function, then I suggest just revert back to old school and raise the hands, and then we'll come off mute for any Q&A. Thank you for doing so for those that have just done so, and we'll pick that up in a moment. With you, Nikki.
Thanks, Phil. Yes, so now I'll step us through what the impact is and essentially the tangible implications of that higher cost environments and what that means for Europe between 2024 and 2030 in terms of the deployment of renewables. So here in this table, we've conducted an analysis wherein we look at how the changing pledges, which mean that the amount of renewables required to be deployed has changed, as well as the change in the CapEx environment, tangibly influences the amount of investment required to deploy these renewables. So if we look to the top row, we have our previous pledge amounts, which required an additional capacity amount to be deployed between 2024 and 2030 of 450 gigawatts. That's held with the previous CapEx environments, which, if you remember that Caspian just mentioned, was relatively low, meant that the total cost of this amount of capacity to be deployed came to around 430 billion euros. If we come down a row, we increase the pledge amount to match the recent Repower EU requirements, which forecast that around now they'll need 510 gigawatts in the same timeframe, but we hold the CapEx to the previous low amount, and so the total cost comes to around 490 billion euros. This is a 60 billion euro increase purely on the basis of increasing the amount of gigawatts to be deployed. And if we come into our bottom row, we have our existing environment in which we have the accelerated capacity deployment, but also that higher CapEx environment. And so now the total cost comes to around 580 billion euros. And if we're just to take a step back for a second, we can see that between our 2022 outlook and today, the increased amount of investment required simply due to increased capacity requirements, but also that higher project financing, higher CapEx and higher LCOEs means that the total cost incurred has increased by 150 billion euros. When we go on to the next slide, we can see what this means when we look at specific technologies. So if we can go to the next slide, please. Thank you. So here we choose to look at offshore wind, as I'm sure many of you will have seen in the media of late that they are highly exposed to these high cost increases. And this is largely due to two main factors. So number one, offshore wind has very long lead times, which means that these PPAs and deals may have been negotiated in a lower CapEx environment a few years ago, wherein the price at the time that was fixed was high enough to still bring in profits. However, now due to changing costs, those profit measures may have changed, and so those locked-in prices are no longer rendering that these projects are still economically viable. The second factor is that offshore wind also has a lot of technological innovation, which means that changing parts also require changing supply chains. And as Caspian mentioned, we see that a lot of the policy measures are coming in place to actually change the way that supply chains are structured. And so we see further costs incurred. If we look at this particular graph, we can see that we've plotted the cumulative capacity foregone in the calendar year of 2023, just for offshore wind projects. Now here we choose to look at both Europe and the US, as we're seeing very similar financial conditions play out across the Atlantic. And we've selected a few just to call upon. So for example, we can see that in June of last year, Equinor, BP and Ørsted all announced their intentions to renegotiate PPAs. As I mentioned before, this is due to the fact that the prices were initially locked in when costs weren't expected to increase so significantly. And so now, in order to keep these projects profitable, investors are choosing to go back to the table and renegotiate so that profits can continue to come in. We can also see that there have been final investment decisions being delayed by Ørsted in June of last year. We even saw terminations in July of last year with Avangrid terminating PPAs, and we more dramatically saw Vattenfall actually halt their production of the Norfolk Boreas project in July of last year. And so this paints a picture of an emerging trend, not only from 2023, but also bleeding into 2024, as we saw in January of this year with Equinor and BP, wherein these higher costs are actually causing projects to no longer be profitable and therefore no longer economically viable. And so investors are becoming more and more uncertain, and it's more difficult for them to be able to secure profits and returns on their investments. Now, this isn't to paint an entirely doom and gloom picture of offshore wind. It's important to remember that offshore wind is still growing rampantly and continues to play an exceptionally important role in the energy transition. However, it offers us a very sharp snapshot into the material impact of these increased costs and what it means for investors in the current day. If we go to
just to butt in slightly. I mean, obviously, we've seen the response now from the UK government on the change to the administered strike price from AR5 to AR6. So governments are responding. I think offshore has proven. This may sound a slightly controversial statement. Offshore has proven to be a good value for the consumer. There is a huge value in large-scale decarbonisation at scale, notwithstanding the benefits to UK PLC through the development of the supply chain. I sincerely hope that AR6 that we see in the UK is successfully cleared. Obviously, there's a lot in the media, in the news now around projects remain challenging even at the increased strike price. So we'll see how that plays out over the next few months. But I think it would significantly jeopardise our 2030, 2035 targets if we see another failed offshore auction here. And government really should be well aware of that. Nikki.
Thank you, Phil. And that actually leads us very nicely into the next slide, where we actually talk about the increased need for this government intervention. So here we can see that actually strike prices have fallen in previous years. Now, this is because we obviously saw that low LCOE and CapEx environments with costs starting to fall. And so prices no longer had to be so high to continue to incentivize investors to remain in the market. And so market equilibrium could be reached at a much lower strike price. As we can see on the left-hand side, in the French onshore wind and solar market, strike prices were falling between 2021 and 2022. And on the right-hand side, we have our GB offshore wind strike price market, and we can see between AR1 and AR4, that those strike prices continue to fall. However, now, as we've seen, these increased costs mean that in order to keep private investors in the market and in order to continue deploying these assets, strike prices are going to have to increase to kind of negotiate this new market equilibrium that is required. And we can already see that the French market has responded to those market signals with the increased strike price between 2022 and 2023. And our Beringer analysis on the right-hand side shows that we do project, as Phil has mentioned, the government will be increasing that strike price to anywhere between the range of hopefully £50 to £65 per megawatt hour. But also we forecast that in the year 2030, GB is set to spend 11% more on CFD payouts compared to our 2022 outlook. And so this goes to show that, yes, these increasing costs are posing a constant challenge for investors in the market. However, governments are proving to step in, not only to continue to incentivize these investors to remain in the market and therefore continue to gain profits and therefore economically viable projects, but also because this is crucial towards those critical net zero targets. Thank you. That summarises our presentation section of this session, and I'll now hand over to Phil for our Q&A.
Thanks, and again, apologies for the dysfunctional Q&A here. We have had some questions come through. Nikki, I'm going to read your question out loud. Given wholesale prices will drop in future, but input prices have gone up, corporate PPAs are looking unaffordable. Do you still expect corporates to sign up at the rate seen over the last few years? I mean, there's a lot in that question. The current projection of wholesale power prices is indeed for them to fall, and potentially the mark-to-market value of a PPA signed, depending on whether it's a fixed price or index price, but let's assume a fixed price signed perhaps 18 months ago. Yes, that will, from the off-taker's perspective, look out of the money based on today's projection of forward prices, and indeed a Beringer projection of forward spot prices. but I do think, and yeah, this is as I said, we are looking at two slightly different or quite different things, really. One is a fixed income contract for the generator, or indeed an indexed contract for the generator. The other is a projection of spot power prices, and the propensity to enter into a PPA. Yeah, there is a treasury-based reason around cost and certainty, and there is an ESG-based reason around the green credentials and the decarbonisation agenda. If we go back to the early days of corporate PPAs, it was very much driven, and Chris mentioned tech firms, very much driven by the sourcing of green and accretive renewables, and cost was important, but a lot of those early PPAs were signed out of the money against any projection of forward power prices for the sustainability driven reasons, and those reasons haven't gone away. The trend then, as we moved into the last 18 months, 2 years, was really around cost and treasuries getting angst about rising power prices, and at least having a degree of certainty and future visibility of cost, and therefore the motivation for corporate PPAs did swing in favour of the cost control rather than the ESG reasons. But I think we're going to see that evolution going forward, clearly for compliance reasons, regulatory reasons, scope 1, scope 2, scope 3 emissions reasons. Corporates are going to have to enter into accretive renewable PPA. So I don't see a diminishing in demand for them, and certainly the amount of work that we're doing both for generators and off-takers to source PPAs is not on the wane at all. Chris, perhaps coming back to you. You raised the initial subject. Any further builds on that?
Yeah, thanks, Phil. I mean, I'd agree with everything you said, and I think it's worth, if we think about what we saw on that slide, the volume has gone off a little bit, but that is a response to price. So really, the amount being spent on PPAs is going to be up. And yeah, I'd agree. I think we see continued demand. We see a lot of companies kind of set their 2030 and 2050 targets, and they're now in that process of working them out. PPAs are going to have to be part of the answer. And I do think there's a little bit of the market that kind of hasn't got the message yet, and it will penetrate through sort of those companies that are thinking they can rely on grid decarbonisation and are going to find that that's probably not going to cut it, not going to be good enough. And indeed, the tech leaders who are pushing this further on beyond the kind of traditional let's buy some solar or some wind, and looking at that 24/7 green power and starting to think into the more innovative technologies, and starting to to think hydrogen or to think batteries and so on. So I think I would see a lot of continued resilience. I think there's a whole load of market still to go for, Phil.
Great. The Q&A functions burst into life. So now I've not had a whole plethora of questions. Let me pick out one here. What would be your reflection on specific technology capture price cannibalization going forward, given the renewables rollout? Does it put specific technologies at risk in specific geographies, coupled with revised upward renewables LCOE trends? So here we're talking about the effects of price cannibalization. So specific technology capture rates relative to baseload pricing. Now, of course, the capture rates for technologies, it's a well-known, very obvious trend that as renewable zero marginal cost generation increases, solar during the day, wind during windy periods, it depresses wholesale prices, and therefore the weighted average capture price for those technologies will be lower than the average. And conversely, not only do they depress power prices when generating, they miss out on the high power prices when they're not generating for solar, typically evening peaks in Northern European markets. So yes, we do see growing cannibalization rates. 5%, 6%, 7% for solar, trending up towards 15, 17, 20% even over the next decade or so. This does and again, my comments here are all based on merchant power pricing. So this is the very purist view of how does a particular technology operate against a day-ahead spot price. Clearly, contractual structures provide some risk mitigation around that, and also technology options, co-location with batteries being the obvious example, also provides some mitigation around that. Yeah, we do an awful lot of investment modelling. So, yeah, whilst we see levelized costs, and they have risen, you know, the Caspian mentioned the supply chain costs, we have seen that uptick in supply chain costs going forward. We do see a reversion over the next decade or so to more normalized pricing, and the LCOEs, both for the capex and capital costs, i.e. the financing costs, reverting back towards more equilibrium levels. So yes, we do see them merchant renewables viable on an economic basis across different, more or less across different geographies. Do we see them making sustained economic, super economic returns? No, we don't. And increasingly for some technologies, solar aside, but particularly for wind and other forms of renewable, monetization against other than just the day-ahead energy market. The number of business cases that we're now seeing, particularly in offshore, at scale, but the number of cases that we're seeing with energy earnings, obviously, either through a fixed income CFD type project, a merchant nose or a merchant tail, but then the provision of both capacity and flexibility service as well. So I think the business case and the economic case for renewables, either through the monetization through different revenue streams, the contractual complexity, or the technology adjacency, will become more complex. But absolutely, we see, despite increasing cannibalization levels, viability for merchant renewables going forward. There's another question here. You said gas prices are high, however, current prices are below pre-crisis prices. That's the today's forward curve. I think we're referencing as we come out the back of another warm winter. Baseload prices at the EX are below Baringa forecasts for the next 10 years. How does this affect closing the gap of renewables? Again, it's a little bit similar to the previous point. Yes, today's forward curve is. And obviously, when any point in time when we produce our projections, we do reference the forward curves. It would be, particularly in our reference scenario, it would be somewhat naive not to observe where the current traded market is. But again, back to the similar point that I commented around the propensity to enter into PPAs for Nikki's question. Taking a medium to longer term view, investors do have to accept that there will be volatility around near-term price movements, whether it's in the forward curve or indeed any projection. And we do still see viability in the in merchant renewables across different technologies going forward. The margins will become tighter. We've seen that over the last few years. The number of questions and inputs that were now being demanded of us around GOOs, as an example, guarantee of origin. A few years ago, GOOs were the equity cream on the cake, for want of a better expression. Very much now an integral part of the business case as people look to eke out value across the full capability of the asset. Perhaps time for one more question.
I just add there on the gas, Phil, when you're finding one, it's worth realizing that though yes we've had the mild winter, Europe's done a tremendous job really in keeping the storage full. We have moved from something where Europe was getting huge amounts of very cheap gas through very cheap pipelines, and now we are going to be relying on LNG. We're going to be competing far more with countries around the world. So sort of a low price today doesn't necessarily mean a low price tomorrow. But there are so many dependencies. What happens with the Chinese economy, particularly in terms of the demand coming from the Far East. But it has moved. It's a little bit like with the renewables moving to a higher LCOE. Europe's moved to a more expensive way of getting gas than it used to have, regardless of what the spot price is on a particular day. Phil, we've got 2 minutes. Do we have another good question to go for?
There's lots of questions. Some of them are quite detailed around CapEx.
Bill, there's just a quick one on the tech variation of CapEx, which I think is correct. So yes, I mean, on the supply chain CapEx front, we are seeing offshore wind obviously being the most affected. And as the question suggests, solar not so much, actually much more stable outlook, downward trending potentially in our forecast as well. And there's an interesting question about how that may impact both policy choices and the obviously options open to developers as well. So yes, not want to overstate the cost challenge, which I think is very pertinent for certain technologies, specifically wind, but clearly less so across different regions and different technologies.
Just on offshore wind, so one of the things that needs to be done is that kind of more plan-led approach, thinking about, you know, supply chain and so on when it's planned. I think we're probably at a point now where sort of there's competition for skills and for vessels and so on, and really the planning needs to catch up all those resources that are going to be needed to make it work, because, you know, the targets are phenomenal, but we wouldn't have the capacity in right now to do that stuff. So governments really need to think about that when they're doing it. Sorry, Phil, go for it.
No, I'm just going to wrap up and thank everybody for joining this morning. Apologies for that gremlin in the Q&A function. We've now got a plethora of questions. Most of you will have my contact details or contact details of the team. So if there is a specific issue that you want to want us to address, do let us know. You can get in contact via the QR codes here. But equally, very happy to pick up on emails directly. But again, once again, thanks very much for the participation. Thank you, Arif, Caspian, Nikki, and Chris for presenting this morning. And we look forward to seeing you in 12 months' time as we reflect on what's ahead of us in 2024.